So here's the big question. Are SpaceX and Palantir brilliant growth machines, or are they already priced for perfection? Let's find out. Reverse DCF says both of these valuations demand elite growth for years. The headline here is simple. These stocks are not cheap. But the real story? It's all about expectations. Now, a normal DCF starts with assumptions. Then it calculates a fair value from there. But a reverse DCF flips that on its head. It starts with today's price and solves backward. And here's what it reveals. The growth, the margins, and the duration that investors must believe in for these prices to make sense. Think of it like this. You're basically reading the market's homework assignment. The benefit? Honesty. There's no hiding behind vague optimism anymore. But the risk? Sensitivity. Tiny changes in your assumptions move everything. Let's start with SpaceX. It's currently valued at around $1.5 trillion. Revenue came in at about $18.7 billion in 2025. And check this out. Second quarter 2026 hit $7.8 billion. That's up 92%. And Musk? He's pointing toward $100 billion in annual recurring revenue. So, to justify that valuation, revenue has to compound at 35 to 50%. Every single year. And here's the kicker. That pace has to last roughly 10 to 15 years. On top of that, final free cash flow margins have to reach 25 to 40%. That's a tall order. Really, this is a triple bet. On Starlink, on Starship, and on orbital computing. All three have to deliver. And right now, free cash flow is negative because the investment is absolutely massive. Now let's turn to Palantir. It carries an enterprise value near $382 billion. Trailing revenue sits at $6.16 billion. And the 2026 guidance? $8.15 billion. That's up 82%. Free cash flow margin is 55%. And adjusted operating margin tops 60%. And get this, its Rule of 40 reached 155. So let's run the numbers. Assume high growth for 10 years, then a 20 times sales exit. What does that imply? A revenue CAGR of roughly 30 to 33%. In other words, that means an average Rule of 40 near 80 to 85. For a decade. Now here's the trade-off. Higher margins soften the required growth. But faster margin decay, that raises it. So on earnings day, here's what you track. Whether that 30% growth still looks durable. Watch United States commercial growth, net retention, RPO, and TCV. Those are your key signals. Here's the line in the sand. If the Rule of 40 stays above 100, the valuation logic holds. Below 80? That's caution. But repeated weakness plus bad guidance, that's danger. This is the power of the reverse DCF. It turns expensive versus cheap into measurable expectations. Bottom line, SpaceX needs bolder execution. Palantir needs graceful deceleration. So here's my question for you. Which expectation breaks first? Launch economics or software momentum? Drop your take in the comments below. I'll be reading every single one.